Today we're going to talk about revenue recognition, why it's important to your business. I'm Owen Karlsson, your ERP coach. Let's truly talk about what revenue recognition is and how it can differ from some of the other terms that are thrown out there, like a booking, a sale, an invoice, cash coming in the door, cash getting reconciled. So if you are a company and you have a contract that you're going to execute with one of your customers, and then there's a price for that contract, right? And how that gets billed, how that gets invoiced could be very different from one company to another. One company might say, for this $100,000 in goods, I will bill you $10,000 today, I'll bill you $10,000 next month, and I will bill you 10 months of $10,000. The billing cadence doesn't necessarily drive revenue. What revenue truly is the money that is earned over time. So if I was given $100,000 up front to do a certain amount of services, just because they send me a check for $100,000 doesn't mean that I get to report on my financial statements. I don't earn that until I've started to do the work. Now, the stuff that you've paid me that I haven't yet earned is called deferred revenue. So if you give me $100,000, that $100,000 has two sides, a debit and a credit. You see $100,000 in our bank account, and the other $100,000 goes into a liability section on our balance sheet in deferred revenue. And really what that's saying is we haven't actually earned this. This is a liability. We owe this $100,000 worth of services or goods to the customer. And then as we do the work, we take a little bit out of that deferred revenue liability and we move it into our income so that we say, now we've earned money. If we're trying to think about how revenue recognition works before you've made an investment in an ERP, let's say you're on QuickBooks or you're, just starting up a business. Revenue recognition is a very manual process, plain and simple. I would bet 99 times out of 100 there is an Excel spreadsheet and there's probably a column that's tracking the original total amount and how much is remaining, or you need to type in a number into the box each month and say, here's how much we've done. To do proper revenue recognition from an accounting standpoint without a tool that has that kind of capability built in, you are more than likely going to be in an Excel workbook, plain and simple. And let's say you have been doing it manually for quite some time, and you start to look at an ERP, and why might you go in and make the investment in the ERP? It's because they have tools available to you that can make this simpler, more streamlined, less error prone. Because it's such a manual process, it is very prone to error. And because it is literally the top line revenue that your financial statements are all driven off of, it is the most scrutinized part of any business. Thank you for watching. I hope this was helpful. If you have any other questions, you can visit zoningco.com, and please don't forget to like, share, and subscribe.